right, so back on the Blackboard, we want to talk about, again, we just covered structured notes. What are they? A debt security by some of the biggest banks in institutions that we buy from. And what are we targeting? For the growth notes, which are 3-year terms, at least 20% is generally what we're going for. Sometimes if it's a compelling case and we see in our testing that it's a very safe note and we want to add that, we will. But generally we're going for 20% growth. Then we look at for income getting paid on a monthly basis, at least 15%. So over 1% a month is going to come into the portfolio, and we'll allocate that back to our investors. Then we have one of my favorites again, because can't forget Warren Buffett's rule number 1, don't lose money. Rule number 2, don't forget rule number 1, again, principal protected notes. So I generally only buy these unless they're going to yield at least 13%. I have bought some in the 12 range, but what this means is an absolutely no loss note. So it's backed by the FDIC generally. It's like the same thing as a CD almost, but you can get more on it because it's tracking the index of whatever you're buying. So it could be NASDAQ, Russell, Dow Jones, S&P 500. And then we're going to go to my personal favorite. We're going to do an example of a growth note that I own and is one of my favorites: Apple, Amazon, and Tesla. So this pays 28% per year, and this is called an auto-callable step down. Auto-callable step-down note. So the term is 3 years. So this note will run 36 months. What we'll do is we'll do our testing and see what is the probability that Apple, Amazon, and Tesla will go down. And this is a 40% downside protection on this note. I'm going to get into protection in a second. So protection is the barrier in which you have the price level. So you buy it at that trade date, you get locked in on that price. So 3 years out would be the maturity date, but most of them get called within the first year. And so I'll explain what an auto-callable step down note is, but here's the scenario. You own Apple, Amazon, and Tesla. If they all go up 1 cent above the trade price, you will be making 28%. That's if that happens. Let's just say in year 1 that happens. Next year, following year from the date in which this traded, you're getting 28% in your principal back. Now let's say it rolls out 2 years and Tesla was down. Like, it's down a little bit this year, hasn't had the best year for my guy Elon. So what happens is it goes out the following year. Now here's where it gets even better, is auto-callable step down notes or step up notes. They compound this 28%. So if this were to go out and all of them were up a penny in year 2, it gets called that following year. You make 28 times 2%, and you still keep this 40% downside protection. This note actually has another feature where I'm just going to keep going because it gets better. Let's say year 3, Tesla goes down 20% still. This particular note has the 40% protection, right? But it also has a step down feature. So the step down feature means on year 1, all of those need to go up again, that 1 penny. Year 2, that 1 penny turns into 90% of the value of these securities. So these could all be down 10%. You're still getting on year 2, 28 times 2. So 10% down, and we'll call that 90% step down. So 90% step down, which basically means you can get 10% down on any of these securities. You're still going to make 28% times 2. And then also on year 3, which is the last year, this is where it gets even better. There is a 40%. So you could have 60% of the value of these securities, 60%. So you could effectively be down 40% on Tesla, 40% on Amazon, 40% on Apple. You're still going to get 28% times 3. So just shy of 90% on your investment. And ultimately, we look to employ strategies like this because, again, you're getting a good fixed upside of 28%, generally called in the first year, or it rolls out the second year. Then you're not, okay, well, if they're each down 10%, you're going to be able to still get the 28% times 2. Year 3, 28% times 3, and they could all be down up to 40%. So it's really difficult based on the testing to not get a note called at some point, and that's why we have such a compelling offer, for these different types of notes. And again, these are generally not offered to the general public because the power of a fund, you're able to get a lot more. The minimum investment on these with different banks is usually around 500,000, some to be upwards of 750 to $1 million. And formerly these were only offered to institutions. So we're bringing this to a market and putting it in a fund vehicle where the more you can put in these type of investment vehicles, the better the yield you'll get as well on each of these structured product securities. So I'm going to take it one step further because this has one more feature I have not talked about, and you're like, wow, there's a lot of different protections here. It can actually go down 40%. I'm still making up almost 90% of my investment in 3 years. Yeah, that's great. Here's my favorite, and the last thing I'll talk about is called 1 star. So this particular note, all you need is that was a terrible star. That's better. All you need is a 1 star. And so very much similar to its name, I'm going to choose Apple in this one because Tesla is obviously more volatile. Apple is my 1 star. The one right right there. And so what this means is that, let's just say worst case scenario, Tesla goes to zero, goes out of business, something bad happens. Elon goes off the rails, he gets in trouble, Tesla's gone. Amazon, something happens, robots take over, goes to zero. Okay, that happens within 3 years. If Apple is up 1 penny, or in this case on year 3, well, actually, sorry, for 1 star is up 1 penny, that's still 100% on 1 star on this particular note, then all of your principal is protected and you will get all of your money back. The worst case scenario in this scenario, if it's only up 1 penny in the 3 years, is you have a no loss in your investment, you didn't make anything. However, all of your principal is protected, and we honored rule number 1 from our friend Warren Buffett, is we didn't lose money. That is a very, very, very low probability. If you check any back testing on Apple, which is one of the biggest companies, which is essentially a huge chunk of the S&P, will be down at that 3-year interval is very, very low. So the power of structured notes, the power of one of our more complex and great growth notes is illustrated here. I hope this is helpful, and I'm going to bring this a little bit closer just to make sure that everyone can see the whiteboard if you want to take a picture. But this is ultimately our Class A structured product growth sample of one of the securities that we own today. This one, by the way, is already on track to be up, or our 28%. Looks like it's going to get called this year. This is one of 36 different custom securities that I personally own, and I believed in this strategy so much that I interest arbitraged my own home with a HELOC at 5%, knowing that I could get more on the yield for one of these particular securities. Formerly, I was a real estate guy. I had a lot of headaches when it came to real estate. I did Airbnb, was a super host. I had long-term tenants that were great. So also, like, I had a lot of good relationships in that vein, but our market, at least in the South Florida market, is not even close to getting a 28% cap rate on any property I've seen. Hopefully this is helpful on structured notes, some of the features, custom securities that we have access to based on the relationships that we have. It's very, very exclusive to work with our providers. So if this interests you, you can book a call. It's a 15-minute discovery call. We only have 99 investors that we can let in right now based on our fund structure. You must be accredited. It gives us the ability to still advertise, but in the future, I do plan to open up other funds and also, keep this same type of structured product class included. We also have an equity share class as well, which is focused more on quantitative equity, which I can do in another video. But hopefully this is helpful. Again, maybe a slight glare. Let's just move that over. You can take another picture if you want, and I can go ahead and wrap this up, but thanks for watching.